I worked in asset management for 9 years, 5 as an analyst, and this is reacting to finance TikToks. It's always a fun one, so let's get straight into it.
If there's one video that could change your life, it's this one, so keep listening. We've moved out of the technology age and we're in the information age, and now we're moving into the intelligence age. The hype around AI is real, and yeah, it will change everything, but the truth is the AI stock boom has already happened. When NVIDIA becomes a household name and when your parents bring it up at the dinner table, that means the easy money's already gone. It's already been made. The next wave that's coming after the intelligence age is going to be the quantum age, and the potential is insane. This isn't science fiction. This isn't an if, it's just a matter of when. And the best part is right now, quantum stocks are still dirt cheap. Just like people wish they bought Bitcoin back in 2008, quantum stocks today are that kind of opportunity. 4 companies that are focused purely on quantum computing are Rigetti, D-Wave, Ionic, and Quantum Computing. I'll list the tickers here. These aren't random penny stocks. These are real players in a $1 trillion future. Do your research, and in my opinion, start buying these now. I am buying these every day and building these into my portfolio because the payoff can be huge.
This is really common on TikTok. It is all about finding the next big thing. If you feel like you've missed out on AI, you want to get in early for the next big thing. And as an idea, I don't really mind it, but it is highly speculative. And quantum computing could be the next big technology, but it's how can you profit from that? And we're still so early in that cycle. It could be the next 5 years, it could be the next 20 years. And the problem is trying to invest into companies that are exposed to that space right now is a little bit like picking the lottery because none of them are making any profit. If you manage to pick the winner, you look back in 20 years and went, oh, I just got in early. But for that one company that did really well, there's going to be hundreds, if not thousands, that totally disappeared and lost loads of money. There's also not a lot of context here. I know it's a short form video and he did list 4 different stocks, but we have no idea why those 4 particular stocks. It's a little bit like me just saying nuclear is going to be the next big investment theme, but without actually saying why specific companies are going to do better than others, because there will still be companies in the nuclear space that will lose money and won't be a good investment, even though as a theme as a whole, it's likely to do well. So it depends how much of a gamble you want to take. And it literally is that, a gamble. You could get a 20x, a 50x on these investments, but it could also go to zero. And that's what you have to be willing to accept, that the money you invest into companies like this, you have to write it off. You have to, money that you can afford to lose and you're willing to accept it could go to zero. You'll also likely still get some exposure from just investing into big tech companies like Microsoft and Google. They're going to be at the forefront of this technology. They might not get the same multiples as some smaller companies, but you're still going to get some exposure by just following those big tech companies. Okay, on with the next one.
This is how I would invest $1,000 if I were starting all over. This is day 1 of 30 of my lessons on finding. First, I'd invest $400 into an S&P 500 ETF, like ticker symbols VOO or SPY. Now, this is typically the largest holding of any portfolio I start, and in the past 5 years, it is up 98%. Next, I would put $200 into QQQ. That's the ETF that tracks technology and growth stocks. And in the past 5 years, it's up 118%. Then I would put $300 into individual stocks. So I would pick 3 stocks and put $100 into each of them. You want individual companies that'll still be around in 40 years or more. So think of your companies like Apple, Meta, Nvidia, JP Morgan, etc. It's important not to buy any penny stocks or speculative stocks. Before I tell you what I would do with the last 100, make sure you're following me for another lesson tomorrow. All right, my last $100 is staying in a high yield savings account, earning interest and also waiting for opportunities. I think this split provides a lot of diversification to stocks via ETFs, as well as some concentration into long-term stable companies.
Right, now this kind of video has to be like 90% of what most investing videos on TikTok are. Really simple to make and it gets loads of views. And the most funny thing about this video is that he said this provides good diversification. And the first ETF he went down was an S&P 500. On its own, absolutely fine. But who looks at the weightings of an S&P 500 ETF and goes, you know what this needs more of? More US big tech. Which is exactly what the next fund is. And then to make it even worse, he's then said to go into some single stocks, which on their own is absolutely fine. You can have a bit of fun with your portfolio. But then he's picked Apple, Meta, Nvidia, and JP Morgan. Stocks that you definitely don't need more exposure to in your portfolio. He's also one of the biggest finance influencers out there. And I'd be amazed if he actually thought that that was diversified. I think it's just easy content to make. You'll also notice that for every ETF, he quotes the performance for the past 5 years, as if that's a selling point for why you should go into that ETF. And I think that highlights a massive issue with this kind of strategy, is that anytime that you would question someone going down a route like this, they'll always come back at you and go, yeah, but look at the returns over the past 5 to 10 years. And they'd be right. They've done absolutely amazing. Big tech has massively dominated and the US has dominated the rest of the world. But this also highlights how young of an audience most people on TikTok are. Most of the creators and the watchers of this type of content, the last time there was a big market crash in 2008, they would have been kids or not even born. And the last time that the US wasn't dominating was a time that they can't remember. Many people forget that in subsequent years after the dot-com crash in the noughties, the US underperformed the rest of the world. And don't get me wrong, these big tech companies could continue to outperform in the next 5 to 10 years, maybe even longer. But when you talk about diversification, you see this in a lot of American creators. For a long period of time, the S&P 500 has been tracking the market. But when you look at the S&P 500 by weightings, when the top 10 is making up nearly 40% of the fund, are you really diversified? If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. Right, on with the next one.
When I sat down for the first time to learn how to trade, the first thing that my uncle said was, everything I'm getting ready to teach you is all you need to know. And he told me that the ones that knew the least amount about trading, that knew nothing prior, were the most successful when it came to trading. People that already have previous knowledge, they develop biases when it comes to trading. They look for other things to incorporate. They have old habits. He said the ones that started fresh and took everything he said for face value were the most successful. So when he told that to me, I did exactly that. Everything he taught me is exactly what I've been using for the past 9 years. That's wild. To stick to something and believe it fully for 9 years, you don't get to see any of the benefits of it the first few years because you've still got to master psychology. You still got to master the strategy itself and the instruments that you're trading. But then to see the benefits that you reap, it's incredible. And I hope that you guys can understand that and try to experience the same thing for yourself. So don't forget to hit that follow button for more trading tips.
Follow for more tips. I was a bit confused what the actual tip was. But in a way, she's right. Like, once you find a good strategy, the best thing is to stick to that and be consistent. But I do find it quite convenient that the people who are most likely to make money from trading are the ones that have no prior knowledge. Almost as if that's her ideal customer. A useful test when you watch any of these kind of TikToks is always check out their profile, check out what they're selling. It gives you the context of why they're creating the type of content that they are. And funny enough, you go on their profile and she's got a trading course that she's trying to sell. It's also a little bit contradictory because she said the people who are most successful are the ones that have no prior knowledge and have no biases. Yet she then followed what her uncle was doing for 9 years. And he absolutely had no biases, but that worked for her. And then she mentioned about psychology. And I find this is a really interesting one because psychology is a massive part of both investing and trading, but it's a really easy out for them because if you were to follow their strategy and it didn't work, they would probably blame it on your psychology. Maybe you entered at the wrong time, you're in the wrong mindset, you exited too early, or whatever it is. They wouldn't blame the system. They would blame the psychology, which is a really complex and really difficult thing to learn. And not everyone can even do it in the first place. But at the same time, they're also saying, oh, it's really easy to start. Anyone can do this. You don't need any prior knowledge. And it's just very convenient. You also have to question with anybody who's talking about trading online, especially if they show a lot of their lifestyle, especially if they're trying to show the glamorous side. I don't think she shows too much in her content, but you've always got to think, why are you creating content? If you have a strategy that works, if you're a good trader and you're making 10 to 20% per month consistently, you're going to have all the money that you ever need. And I know sometimes people say, oh, they just want a different revenue stream and it diversifies. But people forget how difficult creating content is and staying consistent. I know firsthand how hard it is to come up with ideas, come up with interesting titles, thumbnails, how you package a video, trying to stand out, the time it takes to edit and respond to comments and that kind of thing. And never mind going on to short form and long form, trying to manage a business at the same time. If you had a strategy, you wouldn't spend your time doing that. You could diversify in so many other areas, whether it's different businesses, different investments. You wouldn't use content as a diversification tool. And if you're selling the tool that you've made money from, you haven't made your money from the tool. You're making your money from selling the product. Right, on to the next one.
Kevin O'Leary, if you could buy one stock right now, what would it be?
If I could invest in one stock right now, it would be any energy stock. Pick any one you want because I think there's going to be policy change in the United States, and I think energy security and independence is going to be paramount for the new administration, and they're trading at very low multiples and distributing a tremendous amount of cash. Whether you want to play it in the Canadian market or in the U.S., it's energy because it's been just ignored during this incredible run of technology. But is the essence of the economy energy security? Yes, it is. And that's next on the agenda for what I believe will be an administrative change in the United States.
I don't actually hate the idea. And he's been fairly vague. He's just said any energy stock. And he actually makes some good points in terms of policy and the fact that it has been ignored. But you've also got to think, there's a reason why it's being ignored. And also, with the beauty of hindsight, we can look back, because this video was back in June 2024. And I've just picked one of the biggest US energy stocks, Exxon. You can see it's been pretty much flat from the time of that video to now. Whereas if you just invested into an all-world ETF, you'd be up 20%. So while energy is usually a good long-term play, they'll always pay good dividends, you've just missed out on 20% because you've tried to get in too early. You've tried to make a big active play. And if you wanted to invest into a single stock as part of your portfolio, it's unlikely you're going to want to put more than, say, 5% into any one stock. You may do if you have big conviction, but let's say it's around 5%. If you invest into an all-world ETF, you've got about 3% weighting to energy anyway. So you've got to have a real high conviction to say, I want more exposure than that, to risk not getting the returns of the rest of the market. And it's the kind of industry that's very dependent on the price of oil. It's not necessarily a bad investment. It could be a good long-term hold. You get the dividends, but just don't expect explosive growth.
I told you to buy this stock 5 weeks ago when it was just 5 cents, and now it's sitting at $1.80. That's a 36 times return, and some of my followers actually made that move. And once again, I'm not selling a course or charging for anything. Everything I share is completely free. I just post undervalued penny stocks with massive upside potential. And right now, I found another one that shows all the signs I look for. It's a Canadian oil company called Altima Energy. They already have oil flowing from the ground, and they're scaling up production across multiple sites. Their target is 5,000 barrels per day. If they hit that number, it could bring in over $50 million a year in free cash flow. And here's the opportunity. The stock is still trading under 50 cents. It has a low float, small market cap, and a chart that looks ready to break out. Even a simple $100 investment today could realistically grow to $1,500 or more if things play out like they have for similar oil stocks in the past. You've seen what happens when you get in early. Don't miss this one. I'll be posting more plays soon.
Again, this is another one we can use hindsight, because this was posted on the 10th of July. So we could look up this stock that he suggested. It's called Altima Energy. And it's the classic one. And he's right. He's not selling a course or a product. But what he is doing is trying to front run the market and using a big following to essentially pump and dump a penny stock, the same way that people did with cryptos. And you can look over the past year, and you can see this massive spike here. So it was about July when he mentioned it, which was around here. And you can see this massive run up, which would have been people watching this video wanting to get in early, and the classic pump and dump, where it then crashed straight away. And then over the course of the next few weeks, it's then continued to trend downwards. And when you look at a longer time frame, you can see it's been flat for years and years and years. And then you get this little spike up because it's got some traction on some videos, and it's likely it's just going to continue back down again. And you can keep playing this out and out, because even the example he used at the beginning, he hasn't shown the rest of the chart. So you're just showing the spike up. It doesn't show then that you would have had to have cashed out right at the top, and then it crashed all the way back down again. And you just repeat this process, and you can make an absolute fortune if you've got a big enough following. It's just a perpetual cycle. And that snowball just gets bigger and bigger, because the more people look at your strong plays, they might not look into too much of the history of what you've said in the past. They see that first little clip where you've told someone to get in at this price. It's gone up 35x. You go, oh, this guy knows what he's talking about. I'm going to get in on the next one. And if you got in early enough and you're willing to cash out within a couple of days, then great, you can make some money. You can make money off pyramid schemes if you get out quick enough. But it's a highly speculative, massively risky play, and it's pretty unethical in my opinion. Right, what have we got next?
I'm 18 years old, and I'm actually, I trade futures. I'm a day trader, and I've recently started making a pretty large amount of money, and I just want help, managing it correctly and making responsible choices.
When you say you've been making a lot of money, tell us real dollar amounts.
I've been averaging about $15,000 a week for the past 5 months. Last week, I made $25,000.
Wow. Start with.
How I actually trade is I'm a funded trader. I'm actually treated as an individual contractor, and the firm provides me with capital to trade with after they've evaluated me. So really, I just paid for that evaluation fee, which is only $150.
So you're not investing your own money? How do you get paid?
So they take commissions off my trades, and then they give me the rest.
So what's the rest? What do you get?
The 90-cent split, I get 90%, and they get 10.
Wow. Listen,
Wild.
lucky ducky. And I say that on purpose because I feel like this is sheer luck going on right now. And I only say that because a lot of the statistics show that day traders, statistically, it's like less than 5%.
97% of day traders who persisted for more than 300 days lost money. So you are,
I've heard that.
you're not at the 300-day market. And truthfully, I have no ill will. I hope you keep making money.
Making money, yeah.
But the key that I would go is, like, if this was Vegas, we'd all be around you going, dude, cash in the chips and walk away.
I'll stop it there just for time. But what he's just said there at the end is the best advice. Like, if you're that much up, know when you're up and know when to cash out. And going back to the prop firm that he's using, the funded capital, if something seems too good to be true, It usually is. Always remember that. So many people fall into this trap, and I've done many of these challenges on prop firms before. The idea is that you pay a fee. So like he said, there are $150 to do what's called a challenge. And the challenge is essentially a set of tests to you trade using a demo account. And there's certain criteria that you have to meet. You have to limit the amount of drawdowns that you get. You have to hit certain profit targets. If you then meet that criteria, they'll give you money to trade with, and you'll be known as a funded trader. Sometimes there's more than one challenge. They have 1, 2, or 3 different stages. But once you've passed, then you're there. And then if you continue to make money, then you'll get more and more capital from them. But what's quite common is the profit split that he mentioned there, a 90-10 profit split, where any profits that you make, you keep 90% of that, and the prop firm gets 10% of those profits. Just think about that in terms of a business model. To start with, it seems a good idea that you have to pass all of these tests to qualify as a good trader. They are quite basic. I wouldn't say passing a quick test that might take you a week suddenly qualifies you as a good trader and means that you can do it consistently long term. But imagine that as a business. After you get a trader to complete this set of tests, you're then going to give them £50,000, £100,000 or dollars to trade with. And then any profits that they make on that, you're only going to get 10% of that, while taking on all the risk by giving them that capital. Not only the opportunity cost of not earning money on that capital, but they're only getting 10% of the profits. So if the trader doubles their money, it gets 100% return. You're only getting 10% of that, which is obviously 10%. Most of these prop firms will earn their money off these challenge fees, anywhere from like 100 to like £500 to do these challenges. And the majority of people will fail. I can't remember the exact stats, but it's up somewhere like 80 to 85% of people fail these challenges. And as soon as you fail any part of the stage, you have to start again. And then the people that do pass all the stages, they'll give you capital on paper to trade with, but it's most likely demo money. And the idea there is that they know at some point you're going to slip up. The criteria that they keep on you all throughout while you're being a funded trader is so tight, and they're looking for any opportunity for you to fail. And as soon as you slip outside one of these bands, you lose your account altogether and you have to start the whole process again. And they'll just take on the risk of you making profit and having to pay you out because of all the people that they have to fund. That's probably such a small percentage. That's my little rant about prop firms, but that doesn't necessarily mean you shouldn't try them. But I just want you to know exactly what you're getting yourself in for when you go down a route like that. If you truly do have a profitable strategy, even if you start with a small amount of money, that will build up very quickly over time. People are just impatient and they don't want to wait a year or 2 years for it to grow. But the compounding effect is massive, especially if you're making decent returns on a weekly basis. But in reality, some traders can make money over 3 or 6 months, but over 2, 3 years and even longer, they can't sustain it and they eventually lose. Right, we'll go 2 more.
Finance isn't hard. It's just been explained by the same guys that say calm down during an argument. So let's break it down. And today we're going to start from easy to hard. Number 1, market cap. And that's the total value of a company's shares. A quick way to size it out. It's like checking someone's Hinge profile and instantly knowing whether they're high effort or still figuring life out. Number 2 is FOMO buying. And that's investing emotionally when prices spike, usually from hype or fear of missing out. It's like texting your ex when everyone else is in a relationship. Rushed, irrational, and probably regrettable. Next is PE ratio. And that's a company's stock price divided by its earnings to gauge whether or not a company is undervalued or overvalued. It's like comparing his Instagram flex to his actual job. Is that lifestyle real or just well lit? Lastly, we have yield curve inversion, which I think even people in finance struggle to explain yield curve inversion clearly. It's when short-term interest rates rise above long-term ones and often a red flag for recession. That would be like paying more for a last-minute booked motel than a luxury hotel booked in advance. It makes no sense and something's probably wrong.
I actually love this style of content. It's adding a bit of a comical spin to quite complex terminology. I think that's what most people need, how they can understand it on a bit more of a basic level. And I think especially in the investing industry, complexity is what's sold in the past. Because just telling someone to invest into a simple global ETF and be globally diversified isn't sexy, it doesn't sell very well. And whether it's advisors or institutions telling you that you need to have multiple funds, multiple products, and want you to be more active, they want you to move your money around, and that's only going to benefit them from getting either higher fees, more trading fees, and just getting you to be more of an active investor in the first place. And this is why this creator has so many views, because people can understand these terms. You don't need to have the basic and standard definition because people just switch off. But being able to relate it to normal everyday things is exactly what most people need. And I wish more finance content was like this.
So you have $100 and you want to learn how to double it. People who tell you to invest in the stock market, start trading Forex, buy Bitcoin. But I'm here to tell you they're all wrong. You can easily turn that $100 into $1,000 by finding a skill that's very valuable and investing that $100 into learning it. The more valuable you are, the more money you'll have to invest in other opportunities.
It's a little bit cheesy, but in essence, it's a good message. And I always like to think of yourself as a character in a video game where you can upgrade different aspects of that character. And it's a little bit like, say you're in a job that you don't like and you want to get a promotion or you want to move elsewhere. And you look at the barriers for that. What do you need? Is it simply experience? Is it a certain type of qualification? Are there any skills that you can learn? And sometimes there's usually a cost to do that qualification or to learn a new skill. And see that as an investment in itself. It's really hard to visualize because you don't get that immediate return like you might see in the stock market. But it's the kind of thing that you can be really strategic about. And the quickest way to build wealth is to increase your income. You can have the best investments out there, but the more money you can put into it, the quicker it's going to grow. And even if you do a qualification or a skill that doesn't necessarily turn into a new job or a new role, or the business doesn't work out, you've still gained that knowledge. And that might pay dividends later down the line in later life. You never know. Obviously, do your due diligence and make sure the course is actually legit. There's so many courses out there. And remember what I said about checking in that person's bio, what they're selling. And if they've got a flashy lifestyle, always be a little bit skeptical. Have they made their money from what they're selling in the course? Or have they made their money from selling the actual course? And that's a really important thing to distinguish. If you want to avoid the biggest ETF investing mistakes, then watch this video next. Thanks for watching, and I'll catch you in the next one.